Hello and welcome to the Future Homeowner Show. I am your host, Eric Helan, and I am definitely excited for today's episode. We're going to be getting into some different articles talking about what's going on in the market today. And I'm really excited about a deep dive that we're going to do about the 203K, which is an FHA home loan program. I know a lot of people haven't heard of this loan program, but it's going to present some great opportunities for anyone who's aspiring to become a homeowner in today's market. So, without further ado, let's just jump right in. So, the first thing that I want to talk about is an article that came out just today. I believe it was either today or yesterday. And what they're talking about was how the spring housing market is not necessarily seeing the changes or the uptick that we typically see. So, usually, from a real estate perspective, springtime is actually one of the busiest times. And we see a lot of people moving as they get ready to enroll their kids in the next school year. They're kind of figuring things out. So we see a lot of properties come to the market, which we've seen. So there's a lot of listings that are popping up. I heard in Phoenix, Arizona, it's like 22,000 listings on the market, which is crazy. Here in San Diego, I mean, we usually have about 4,000 to 5,000 listings. It just depends, but we are seeing a number of listings hit the market. But the slowdown that we're seeing is due to this perception that, home prices are still high, rates are still high, and buyers don't want to overpay for a home. So that's what it comes down to. They're really concerned about overpaying for a home. And if prices were to drop, they don't want to be kind of holding the bag, if you would. And so we are seeing, like I said, some strong numbers for new listings. We're still up year over year, month over month, it goes back even as far as 2022. We're seeing a very strong spring. So that is good news. We are seeing properties hit the market, but we're just not seeing homes go pending. So homes are sitting on the market a lot longer. They're not getting offers. And the purpose and the reason behind that is that with the rates being where they are and the perception of home prices potentially going down, buyers are scared to quote unquote pull the trigger. And so from a buyer perspective, I want you to understand this. If you're getting a home loan and you're buying the home with a lender, so a loan officer is helping you buy that home, the bank is the one who's qualifying you for that mortgage, but they're also the ones that are paying for the home. And they don't want to overpay. Banks are not in the business of overpaying for a home at all. And so their objective is to make money on the money that they loan out. So if you are getting a bank loan, typically that lender is going to require that you get an appraisal. So what is a home appraisal? A home appraisal is a third party. It's an appraiser who comes out to the property. They analyze the property. They look at comparable homes, which we call comps, and they're trying to see if this home is truly worth what you're offering to pay for it. So let's say the home is listed at $525,000. You make an offer at $500,000. As you go through the escrow process, depending on the state that you're in or working with your real estate attorney, there will be an appraisal done in that process. And the appraiser is going to tell the lender how much the home is truly worth. So again, it was listed for $525. You made an offer at $500. The appraiser may come back in and say, well, hey, the home is worth $485,000. Uh-oh, what do we do? You're overpaying for the house. Well, not necessarily. That gives you an opportunity as a buyer to go back to the seller and say, hey, the home got appraised for less than I was willing to pay for it. The lender is not going to not going to overpay for the house. And so you can try with your agent to renegotiate the contract down to the $485,000 appraised value. So it gives you an opportunity to get the home even less than what you were willing to pay for it. Now, if you can't come to an agreement with the seller and the seller says, hey, I'm not willing to sell it for that low, even though it got appraised for that low, it provides you an opportunity to go ahead and cancel because you have an appraisal contingency in your contract. Make sure you don't waive that. But the appraisal contingency is going to give you an opportunity to say, it didn't appraise for what I was willing to pay for it. So now I'm going to go ahead and back out of this contract. We're going to cancel because we can't come to an agreement, and you're going to get your earnest money deposit back. Okay. So keep that in mind. The lender is going to get an appraisal done. That appraisal is going to keep you from overpaying for the home. Now you might be asking, well, what happens if the appraiser comes back and says the house is worth $550,000? Well, that actually works in your favor as a buyer. So what that does is say, I'm willing to pay $500. The appraiser says it's worth $550. Now you have $50,000 worth of home equity. So the appraised value is actually coming in stronger than what you're willing to pay for. So you bought that home at a discount. So congratulations, you have instant equity. So it doesn't work against you, but it works in your favor to protect you. So keep that in mind. If you are buying and you're afraid to make an offer because you don't want to overpay for a home, if you are getting a loan, you will have an appraisal contingency in that contract to protect you. And when that appraisal is done, it's going to ensure that you don't pay too much for that house. So if you have any questions about that, definitely talk to your real estate agent. Ask them questions about the market. When you're going to submit an offer, ask your agent to provide some comparables. What are other homes selling for in the area, to give you an idea as to what that home can go for before you make your offer. So you're making an informed offer on that property. Now, when the appraisal does come back low, let's say it comes back at that $485,000, if you truly want the house, you can come out of pocket and pay the difference. But the bank is not going to fund a $500,000 loan on a $485,000 property. So if you truly wanted it, it was highly competitive, it's just like the perfect home, and you have the funds to do so, you can pay the difference. And especially if you're planning to live in the home long term, long enough for you to kind of earn that equity back, then it might make the most sense for you. We saw during COVID times, people were doing this, pretty much every transaction. They were paying above and beyond what the home was worth and what it appraised for. A lot of people were waiving their appraisal contingencies. And something that I just don't recommend for first-time home buyers. So definitely talk to your agent, make an informed offer, know what the homes are selling for in the area, but realize that you are protected at the end of the day if you're getting a loan with that appraisal. So, don't be afraid to make that offer. The second article I want to talk about is kind of one that's trending. There's a lot of talk, about pros and cons of this concept, and there's a lot of heat in the marketplace for, this topic. And that topic is dealing with data centers. Now, data centers are becoming a hot topic because of artificial intelligence. Artificial intelligence need computer processors and data centers in order to work their magic, if you would. A lot of the technology behind AI is held in these data centers. And so data centers are popping up in communities, typically on the outskirts of communities, because there's a lot of drawback. And one of the biggest things that we're starting to see is that these data centers are giving off heat in the community. And so they're making communities warmer, and then you can expect, different effects because of that. And so there's a lot of, like I said, it's a hot topic, but we're looking at, instead of doing these large data centers in communities that give off so much heat because of the processing, why don't we look at smaller data centers, what they call mini data centers, and put them in suburban backyards? Now you might say, well, I don't want it giving off the heat. These mini data centers don't give off the heat like these large data centers do. And in fact, this could be a win-win scenario. And so I'll talk to you a little bit about why this matters. So a major home builder, Pult Homes, is actually looking at and working with a company called Span to put these mini data centers in your backyard. Now, when you buy new construction, especially here in California, we have certain requirements when it comes to electricity. In fact, when you build new construction, you have to put solar on a home. That's a requirement here in California. And with that solar and with the available electricity that has to be ran to each and every home in a new community, they're finding that most people are only using about 40% of the capacity of the electricity that's available to that home. So with your solar, with your normal electricity usage and the amount of electricity available to you, the amount of power that's available to you, most people are only using 40%. So with the concept of these mini data centers are saying, hey, let us install a mini data center in your backyard, pretty much the size of an air conditioner condenser, and let us use that additional capacity. And in doing so, what they're offering is they'll either pay your utility bills, so that's a good win. You don't have to pay any utility bills. Or they'll give you a flat fee, or you'll pay them a flat fee every month, like $150 a month for your electricity and your internet. So that would cover your internet usage as well. Now, I don't know how it is in your neighborhood and what you're paying for electricity, but here in San Diego, we have some of the highest electricity utility costs in the nation. And so on average, what I prep my clients for is expect your utility bills to be about $400 to $600 a month. And now if you have solar, depending on the amount of panels that you have, if you have just the minimum that's required by the state, the law, then you could still be potentially either paying an additional cost to lease those solar panels, or you can pay for them up front. But you do have to have the solar there. So let's say if you're paying $500 a month in utility, you got another $100 a month to pay for your solar lease, then you're paying $600 a month in your total utility costs. If you were to allow a company like Span to come in and install these mini data centers, now they're paying that cost for you. So you save $600 a month, or they're just charging you $150 a month. So you're still saving, $450 a month. So there is a win-win scenario. We'll see how this plays out. Obviously, this is not being rolled out throughout the country right now. There's actually some small subset communities that are seeing this. I think they've installed about 8,000 units so far. But it could be the potential to make a big change, on how we build new homes throughout the country. And the cool thing about this is that they actually provide a battery backup system as well. So typically you would need to pay for a battery backup, where this is kind of included in the package. So you can kind of see how they have it modeled here in the photo, where, it looks like an AC, you have your battery backup, and you have another panel, a sub panel, in order to kind of keep it out of sight, out of mind. But it really looks neat. It's not a big bulky thing, and we'll see how communities respond to this. I think it'll be a great alternative to the large data centers that they're planning to build throughout the country because of the backlash on those. And it could be some cost savings to help you get into your first home, so you're not having to come out of pocket with so much money for your utility costs. So something to keep in mind. Obviously I would love to hear your feedback, what you think about that, if that's something that you might consider, or if it's, not even an option. You're not looking to put, any type of data center behind your home. So we'll see how that plays out. But let's jump into the topic that I want to cover for our deep dive. There's a major home renovation, home construction loan out there that most people aren't aware of, and very few people take advantage of. And that's the FHA 203K loan program. Now, the FHA helps a lot of first-time home buyers. Their traditional loan program is a 3.5% down payment program. So it's one of the best out there. There are 3% conventional loans, but for most first-time home buyers, they're utilizing the FHA 3.5% down with one of the better interest rates in the nation. And you can, on top of that, you can still have down payment assistance and closing cost assistance as well. But the FHA actually does have a renovation loan program that most people haven't heard of. And as I mentioned, that is the 203K loan. Now, this is their fixer upper loan. And the reason why this is important, especially in today's market, is because a lot of times buyers want to buy a home that's completely done, is turnkey, is ready to go, ready to move in. But oftentimes that price point is too high for them. They can't quite afford the payment on a home that's totally revamped and ready to go. So with this loan program, this allows you to buy a home that needs the work. You have the loan that's part of paying for the purchase and the construction, and it allows you to fix up the home how you see fit with the finishes that you want to truly make it your own. So you can buy a home, you borrow the funds that pay for not only the purchase but the renovation as well, and you roll that all into just one mortgage payment. I'm going to give you some details on how that all works. Instead of buying a house first and then like you're trying to come up with the money to do repairs, this is kind of the solution for that. So you're not putting it on credit cards, you're not adding additional debt, and you're not having to come out of pocket in order to fix up your home. So it's a great program that's out there. So let me give you an example. Let's say you're buying a home, you found a home, it's been sitting on the market, needs a lot of work, and it's priced at say $400,000. You know that it's going to take about $50,000 worth of work to get this place ready to move in, ready to go, and making it a home for you and your family. So what happens is you actually will take out a loan on that full amount, that $450,000, as opposed to just the $400,000. And so you do have to get approved for that amount. You have to be able to afford that payment. So keep that in mind. But it gives you an opportunity to roll those construction costs into your loan and take care of the work. So you're not coming out of pocket and you're being able to close without having to take on that additional debt, like I was saying. Now, this program really matters because there's a lot of homes that people just can't afford. And so when you find a home that needs a lot of repairs, chances are you're going to have less competition. There's not a lot of people looking for a home that needs work, to be honest with you. A lot of the buyers that we work with, they want something turnkey. They want to move into the home. They want all the finishes that they've seen on HGTV, and they want it in their price point. And sometimes that proves to be very difficult. So this is providing an opportunity for you to be able to buy a home that you can actually afford, where you're not living to pay the mortgage, and you're getting all the latest updates, all the latest trends, all the things that you want to see in the home. You can actually put it in the home, and so it's not cookie cutter, if you would. So it opens the door for you to buy fixer-uppers, outdated homes. If you're driving around a neighborhood you love, try to find, they always say the old adage of finding the ugliest home in the best neighborhood or on the best street, gives you an opportunity to do so. And like I said, it's going to scare away other potential buyers. So you should have less competition in order to purchase this type of home. So there are two different aspects or two types of this 203K loan. You have your limited 203K, which is for your basic renovations. These aren't structural renovations. These aren't adding a room or, having to redo the foundation or the roof, things of that nature. This is like if you want to redo your kitchen with, countertops and cabinets and flooring, things that you see on the HGTV shows that are out there, those are kind of your standard construction projects. Again, it's not structural. These types of projects, you can borrow up to $75,000 to do this work. So, and it can be multiple rooms. It doesn't have to just be one project. It can, be your bathroom and your kitchen, and you want to do them both, and it's going to be about $60,000 to do so. So you can actually roll that into your loan up to $75,000. And this was a big change that came in 2024 because it used to only be up to $35,000. So it more than, we're seeing that it more than doubled in the last couple of years. So again, paint, kitchens, bathrooms. You can even replace your HVAC system, upgrade that. So there's things that you can definitely do within that budget. Now, their standard 203K actually doesn't have a limit It has a minimum. You have to spend at least $5,000, but there's no cap. The only cap is the FHA loan limits for your county. So every county has FHA loan limits based on the type of home that you're trying to purchase. And so you'll need to talk to your agent, talk to a lender, and I'll get into how you who to add to your team in a second. But talk to your real estate professionals about what are the FHA loan limits for my neighborhood, my county. It's county based. And so right now I can tell you for San Diego County, a single home has a loan limit of just over 1.1 million. And guess what? You can use this program for a duplex, a triplex, up to 4 units as long as you're living in one of them. So a 4 unit actually goes up to $2.1 million here in San Diego County. Let me give you a little scenario here, a play. If you were able to find a $4 million property, and let's say the purchase price is $2 million, your loan is going to be under that. You're putting 3.5% down on this, and you're using the income from those other 3 units to help you qualify for that. And now you're taking the FHA 203K to totally fix up these units and make them turnkey, beautiful units that you can rent for even higher prices. You're setting yourself up for generational wealth to come years and years down the road. Eventually, because you're buying this as owner occupied, you're living in one unit, you can turn around a couple of years later and go ahead and buy another property, take the equity out of that 4 unit and purchase another property and now you can rent out all 4 of those units if you refinance out of that FHA owner occupied loan. So there's a great opportunity here. Don't just think about, maybe you're thinking just a condo or a townhome. This can actually open the door for you to get into a multi-unit property utilizing this program to offset your mortgage with income coming in and also offset the construction costs with the 203K. So single family home, duplex, triplex, fourplex, some condos, some townhomes, all available. The property just has to be at least 1 year old, so it can't be brand new construction, and it has to be owner occupied. You cannot try to turn this into an investment property right out the gate. You have to live in the property. So those are the rules in order to use this program. So another thing to keep in mind, as I mentioned, you have a 3.5% down payment, just like a traditional FHA. If your credit score is 580 and above, it's 3.5%. If it's less than 580, so it can go all the way down to 500, but if it is less, you do need to come in with 10% down. Okay, so it is a 10% down if you have a credit score less than 580. So you can buy a fixer-upper with basically the same down payment terms as a single-family home on FHA. So definitely take advantage of this type of program. Utilize it to buy your first property. Like I said, turn it into an investment. Set yourself up for generational wealth. Now, the way this process works is you have to start with a lender who is familiar with this program. Okay, don't just use any lender out there. Interview a loan officer. Talk to them. Do you know about the 203K loan? Have you done them in the past? How did they go? What was your experience? Can I talk to, maybe you want to talk to the clients that they've helped utilize the program so you can get, their testimonial, if you would. You're going to need to interview lenders. This is not going to be your cookie cutter program. You need somebody who's familiar with this program. So step 1, you need to get an approval with a lender who is familiar with the program. Not every lender understands these programs, so talk to a few of them, okay? Step 2, you need to find the actual fixer-upper property that you want to purchase. So again, look for outdated homes, the ugliest home on the best street. Look for homes that have been sitting for a long time. Those are obviously opportunities to where, maybe there's not a lot of buyers who want that home, so you have less competition. You may be the only offer on the table. Look for cosmetic issues. If there's just cosmetics, things that don't look good to the eye, look at that as an opportunity. So you really need to look at this from more of an investor standpoint, because you need to see the project finished as opposed to the way the current conditions are. So look beyond the issues that you may find and recognize them as opportunities, not issues. And then the third step is going to be you need to find a contractor or multiple contractors to get bids. So at least 3 contractors that you'll want to talk to and get bids from. Now, let me caution you here. This is one of the biggest mistakes that we see people run into when they utilize this program. They often want to go with the lowest quote possible. And I would really caution you with this. You don't want to go with the cheapest, cheapest bid, the lowest bid, because the contractors who know their value, who are familiar with these types of programs or the types of work that you need done, they need to be competitive. And if they're the cheapest, maybe they push your project to the back burner. You start to look at overages. Maybe they bid it low just to get the job. And then all of a sudden you're seeing price increases, which, by the way, would be out of pocket because you've already got your financing. So you really want to utilize a contractor who knows what they're doing, they're experienced with the work that you want to get done, and there's somebody who's going to give you an accurate quote. You're getting a loan based on this quote because it's your purchase price and your construction costs. So you want to know what those costs are before getting that loan. And you don't want to see overages happen through the process. So get a detailed repair estimate. Don't just talk to somebody who walked through the home and says, oh, it's about $40,000. No, details matter. Make sure they're licensed. So you can check the license of contractors in your state. And then get a full scope of the work to be completed. Okay. Now, step 4 is actually getting your approval based on the what we call after repair value. So there will be an appraisal that gets done, and it's going to that appraiser is going to look at the property in its current condition. It's going to have the scope of the work from your contractor as to what's going to be done, and then it's going to give a value based on the home after construction has been completed. Now, this is different from a traditional FHA loan. FHA loan is just going to look at the house the way it is, compare it to other homes on the market, and the appraiser is going to give a value. So again, this is the after repair value, what we call an ARV. Okay, so after the construction costs are done, this is what they're looking at. Your loan is going to be based on either 110% of that ARV or the full project cost, which would be the purchase price plus the actual amount that you're going to spend. Okay, so it depends on your scenario. Talk again with the lender, find out how they're going to use that appraisal and what they're looking to, as far as a value. And that way you can understand what that appraisal is based on. Okay, so what will that home be worth after the repairs are done? That is step 4. Step 5 is actually closing on the loan. So when you close on that loan, the lender is going to pay the seller, basically what you offered. And that difference, that construction cost that you have built into that loan is going to go into a separate escrow account. Okay, so you don't have access to that money. They don't put it directly into your bank account. It goes into a separate escrow account. As you do the work, as the contractor is doing the work, they're going to have their scope in phases, and those phases are called draws. So at every draw, every phase, they're going to make a request to get funds from that escrow account, which pays for that draw. Okay, so again, that money is not all coming to your bank account. You're not responsible for it. It will go into a separate account, and the contractor will make draw requests at each phase of construction. So they're not getting all the money up front so they can take off on you. And they're not being held, they're not holding those funds to the very end, because obviously the contractor will have cost incurred. And so that will need to be paid out at that time. So there are some pros. Obviously, this is a great program, a great opportunity, especially if you're looking at building generational wealth. Number 1, you have that low down payment. You have 3.5%. Number 2, credit. If your credit is below a 580, you can still qualify. You just need to come in with more money out of pocket. You have one loan instead of basically having 2, so it's just one loan. You're not paying for the purchase and then having to come up with these extra funds. And we see a lot of people, unfortunately, put it on credit cards and things of that nature where they're paying high interest rates. You're buying the house with less competition, which is great because, again, these are fixer-uppers, and a lot of people who want to deal with them. If you want to take that project on, you're going to have less competition, a better opportunity for your offer to get accepted, which is important. I'll kind of go over a reason why. But it also allows you to build equity faster. So again, you're purchasing the property and you're buying it as the ugly duckling, and you're going to fix it up and you're going to make this beautiful home that you love with the details and the upgrades that you truly want. And it's going to make a difference. It's going to really add value to that home. So you'll build equity a lot faster. And like I said, you can customize it the way you want it. There are some cons. And so this is why it's important that you work with real estate professionals, a lender who's familiar, an agent who's familiar with these programs. So typically the biggest con is that it does take longer for you to close on these types of loans. So a standard, what we would call a standard escrow process or time frame to close on a home, it's about 30 days. You can definitely close faster. It can go longer, but about 30 days is kind of the standard. With these types of loans, it will take 45 to 60 days. So buying a home with the 203K will take longer to close. So you have to be aware of that up front and let the seller know that when your agent is writing your offer that you're probably going to give yourself about 60 days to close. So keep that in mind. These loans can be a little more complicated because you're dealing with additional folks. So you do have contractors, you have an appraiser, you have these other characters in the cast, if you would, that need to all come together to make this work. So that's why a lot of lenders, unfortunately, don't work with these loans, is because they're seen as complicated. They don't necessarily know how to go through the process. That's why it's important that you talk to a lender who is familiar. If you need help in finding a lender or a real estate agent in your area, let us know. We do have a search tool on our website. So reach out. We'll send you the link, and then that way you can find these professionals who are in your area. And so, like other FHA loans, this is kind of like a con, if you would. There is mortgage insurance. So I've talked about mortgage insurance before. Mortgage insurance is basically when you're coming in with less than 20% down, the lender requires an additional cost. It does add to your monthly mortgage payment. That's included. You will have like upfront mortgage insurance premium, but then your mortgage insurance that you carry for the life of that loan that you have with FHA until you do a refinance and refinance out of that FHA loan. That mortgage insurance will be there. So keep that in mind. So again, some of the mistakes we definitely have seen where people go to lenders who aren't familiar with the program. We've seen people use the cheapest contractor that they can find, which is a major, major issue. Underestimating renovation costs. So really you want to lock in your costs, get a very detailed scope of work from your contractor. And then, trying to renovate too much. I would say you're a first-time home buyer, try to obviously you want to make the home, a great home for you to move into. You want to customize it the way that you want to see it. But don't take on more, don't bite off more than you could chew. Okay. Just really try to take on the projects that are going to make the home move-in ready. They look good. And you can still do other repairs, other projects down the road, DIY if you want. So don't try to do it all at one time. So, keep that in mind. Keep those renovations to the amount of renovation that you need in order to move in, make it your own, but don't go overboard. So that is a mistake that we've seen. So again, this is a great project. You should definitely take advantage of it. Talk to a lender. If you need somebody, if you need help, reach out to us. We can help you get there. Okay. If you have additional questions about the 203K loan, don't hesitate to reach out to us as well. We love to kind of go over it and maybe answer any questions that you may have. And that way you can, get all the information before diving headfirst. Talk to somebody, get approved, build your fixer-upper team. That's your contractor, that's your agent. And really just don't go out looking for, the prettiest house. This gives you an opportunity to now go out, find a home that you can put some sweat equity into and really start to build up your net worth and your future net worth. So keep that in mind. That's all I have for the deep dive portion of today's podcast. At this time, I do want to get into our Q&A. We got a couple questions that I want to get to. And I really want to encourage you, if you're watching this podcast, if you're watching the live stream, if you're watching, down the road or listening to it on podcast platform, don't hesitate to reach out to us, ask questions, find us on social media, go into the comments on YouTube, ask your questions. There's a lot of questions that go unanswered. And so the biggest thing that I can do is just kind of encourage you to ask any question, even if you feel like, oh, it's a stupid question, or, I should know this, whatever the case may be. Don't hesitate to reach out to us. That's what we're here for. So this portion of our podcast we call Real Questions, Real Answers. And I'm going to cover 2 questions that came to us this week. That way, hopefully they can help you. The first question we got was, are there any home buying programs for first responders? So the answer to that is yes. So if you're working as a police officer, firefighter, a nurse, doctor, even teachers, there are down payment assistance programs that are out there for you. Talk to somebody who's familiar with the down payment assistance program. I caution this because we've had clients who are nurses, and unfortunately their household income was too high to qualify for the programs that were out there, but there are programs out there. So yes, those are available. Not only down payment assistance programs, but there's also like grants and special loan programs. So maybe you have a lower interest rate, or you get a grant, a one-time grant to pay for your closing costs that you don't have to pay back. So yes, those programs do exist. So if you're a first responder, if you work in any of those fields that I mentioned, definitely take advantage, talk to your real estate agent, talk to your lender about those types of programs that are available to you. Second question that we got was, are there, that was the first question. So second question, we'll just cover that question. I covered the first question twice. So that was the only question that we received. Again, if you have any questions in the future, don't hesitate to reach out to us. On our last podcast, we covered the question of, are interest rates going to go down? Because we get that a lot. So no, I don't know if interest rates are going to go down, but I will tell you, especially going back to that first article we covered, if you're worried about overpaying for a home or buying a home that you can't afford, get an appraisal, talk to your lender about your budget. You're going to have these protections in place so you're not overpaying for a home. You're not living to pay the mortgage. We don't want to help people buy a home that they cannot afford at the end of the day. So keep that in mind. Hey, listen, if you got any value from today's episode, definitely, subscribe, share, talk to other folks who are maybe looking to buy their first home or looking to get out of paying rent and paying off their landlord's mortgage. Share this episode with them and have these conversations. Ask the questions. That's what we're here for. We want to make sure that this is a resource for you. If you're serious about buying a house, we want to help you take that first step, help you take the next step, and help you get into your first home as soon as possible so you can start building generational wealth for your family. That's all that I have for today. I really appreciate you jumping on or tuning in or downloading the podcast. Again, reach out to us if you have any questions. And until the next episode, have a blessed week. Take care.